If you asked private investors what triggered this year's stock market meltdown, most would probably name the war in Ukraine. The possibility of the conflict with Russia causing a global catastrophe has hammered sentiment, but it's not the prime cause of the crash. Others may point to rampant inflation, triggered by this year's energy shock and post-COVID supply shortages. It's not that either. China's ongoing pandemic lockdowns haven't helped, but the number one threat hanging over markets is none of the above. It's the U.S. Federal Reserve. The Fed is the main reason why markets and investors are running scared, and the recovery won't come until Chairman Jerome Powell changes his hawkish tune. When he turns dovish, markets will fly again. Some reckon that day isn't far away and investors should be ready for it. There's an old saying that bull markets don't die of old age, but are killed by the Federal Reserve. That has certainly been the case this year. The Fed could have saved markets from Russian President Vladimir Putin, just as it saved them from the global financial crisis in 2008 to 2009 and the pandemic in March 2020. All it needed to do was give them yet another blast of cheap money in the shape of near-zero interest rates and yet more quantitative easing. And it would almost certainly have done so, if it wasn't for inflation. Instead of bailing out the U.S. economy, as it has done for the past 25 years or so, the Fed is actively aiming to smash a hole in the bottom by engineering a recession to stop prices from raging out of control. It has reversed decades of monetary loosening by increasing the Fed funds rate from 0.25% to 3.25% in 8 months, and shifted from K to QT. Quantitative tightening is now shrinking the Fed's balance sheet by $85 billion a month. This is draining the global economy of liquidity, causing that crash we see around us. Fed tightening has caused havoc and sent investors running for cover, says David Morrison, senior market analyst at Trade Nation. There are few safe havens as Mr. Powell gets belatedly tough on inflation. The S&P 500 has fallen up to 27% this year, while many bond investors are down 40%. Even traditional inflation hedges, like gold, have failed to shine, Mr. Morrison says. Markets anticipate more tightening to come, pricing in a near 100% probability of another 75 basis point rate increase to the Fed funds rate at this week's meeting, which would lift it to 4%. Yet, there are growing hopes that Mr. Powell may soon strike a more dovish note, Mr. Morrison says. Just a month ago, analysts were anticipating another 75 basis point hike in December, but they have now dialed down this forecast. Given that rate hikes act with a lag, it makes sense to slow things down to avoid a deep recession, he adds. The Fed's meeting on Tuesday and Wednesday this week could be pivotal. If the Fed signals, either in its statement or in Mr. Powell's subsequent press conference, that it's preparing to back away from an overly aggressive program of monetary tightening, we could see a significant market turnaround as we approach year-end, according to Mr. Morrison. Jeremy Batstone-Carr, European strategist at Raymond Williams, also sees grounds for optimism. While in the very near term, base rates are going higher for sure, a de-escalation in the tightening process may not be too far away, he says. Investors have priced in a host of challenges, including tensions over Taiwan, COVID restrictions in China, UK and European political and economic disarray, and the collapsing Japanese yen, but Mr. Batstone-Carr says they have missed something. What has not been discounted is the likelihood that the eventual outcomes from the array of crises befalling the planet in 2022 may conclude constructively. He suspects a recession, expected late 2022 to 2023, may prove short and shallow, and successfully reduce inflationary pressures. This, in turn, will likely cause the rate hiking process to peak, at which point markets will focus squarely on monetary policy easing. With the challenges of 2022 in the rearview mirror, the happy issue for investors will likely be how best to position portfolios for a more constructive future. This year's global equity weakness has taken much of the froth out of absolute valuation metrics and laid the groundwork for a more constructive 2023, Mr. Batstone-Carr adds. The money supply is shrinking fast, suggesting that the Fed is winning its inflation fight, according to Giles Coughlin, chief market analyst at Hike.